Thanks for joining us today on Market Call. Morello Fernandez. Julien Nono-Womdim on the show with us today, Vice President, Equity Analysis at Goodreid Investment Counsel. He'll take your questions on U.S. equities, and here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Good to see you. Thanks for coming in.
Likewise. Thanks for having me.
Let's talk about the market so far for 2026. What would you say January looked like, and is it an indication of the rest of the year?
Yeah, we think it is an indication for the rest of the year. How we see it is a world beyond the Magnificent Seven. So far, we've seen outperformance from the equal weight S&P 500 relative to the S&P 500. We've also seen strong participation from small caps. And really, there are two reasons for that. First, the earnings backdrop is strong, not only amongst the large companies, but smaller companies are starting to participate. And secondly, policy, even though it's been noisy, when you think back to the tariffs, what they've actually done is they've created an influx of capital into the U.S., capital investment. And also the one big beautiful bill is actually going to be stimulative to lower end consumers. And we see that as a positive. What I'd highlight further, though, is that this isn't just a January effect. We started seeing a rotation into small and mid cap equities following the April drawdown of last year. And it's continuing.
All right. The retail numbers from the U.S. that were out today were not great. They were very flat for the end of the year. I'm wondering if that gives you any reason to pause when you look at the American economy.
No, not at all. I mean, the data is going to be mixed. It has been mixed. On the one hand, the labor unemployment numbers are a little bit sort of soft. On the other hand, GDP growth is actually strong. We think this cycle is really being driven by a reindustrialization of the U.S. economy. That's number one. Number two, while the U.S. consumer, particularly the low-end consumer, has been weak, not just in 25, but this actually goes back to 2023 and 2024, we think that the compares are easing. We think that the consumer, while relatively weak versus, call it 21 and 22, is still hanging in there. So we're not particularly concerned just yet.
Okay. Do you think that the tax refunds, the extra cash in the pocket for consumers in America, will boost the spending from that lower tier group? We keep talking about that K-shaped economy, right?
Right.
I'm wondering if that'll be enough of a boost to promote some spending from that group.
Correct. We think it will be towards sort of the back half of this year. And as you know, the propensity to spend is actually higher among sort of lower income consumers. Higher income consumers, the wealth effect doesn't sort of propagate into the economy as well. So we think spending velocity should increase.
Okay. Let's take a quick break then. We will line up some phone calls and some emails for Julien of Goodreid Investment Counsel. Again, he's taking your questions today on U.S. equities. Here's how to reach us. Back in a moment. Welcome back. We're going to start with an email from Steve. His question for Julien is, what are your thoughts on investing in JP Morgan? Is JP Morgan one of the financial institutions you invest in?
Yeah. Hi, Steve. Thanks for the question. We own JP Morgan. It's been a core holding for us for a long time. Extremely well-managed bank. While we own it, continue to like it, at this particular point in the cycle, we actually prefer other banks. Steve, stay tuned on that. But what we're seeing is other banks that have more sensitivity to the interest rate curve, to the yield curve, should do better. Other banks that perhaps have a little more sensitivity to loan growth should do better in the sort of short to intermediate time frame. So 12 to 18 months.
So you're banking on some rate cuts?
Banking a little bit on rate cuts, banking a little bit on loan growth, and we are starting to see that from other financials. The other thing to consider is that the valuation of JP Morgan reflects the quality of the franchise.
Okay.
Yeah, but we own it.
Let's go back to the phone lines then. We have Chris on the line in Delta, BC. He's got a question. Hi, Chris.
Hi, Morella, and hello, Julien.
Hi, Chris.
Julien, I'd like to ask you about Lennar and the home builders in general. I believe your colleague, Gordon Reid, who I followed and admired for years now and has really served me well with his words of wisdom, he is a fan of this sector for the long-term tailwinds of essentially there has been no new housing supply, and there's a lot of impediments to that situation really changing. But when it does, there'll be sort of a wave of momentum of need and demand for new homes and renovations and the age of the housing supply, et cetera. So I'd just like to hang up and hear your thoughts on that.
Yeah.
How hard is it to time something like that?
Yeah, so it's a little difficult. A few things to parse. Chris, thanks for the question. First, Gord is my boss. Second,
You would never go against it.
Second, I have gotten a lot of wisdom from him, and I would say our overarching thesis is that the U.S. is in a structural housing deficit. That's been clear. But in the short term, the supply and demand of houses can change, and over the last few years, we've seen the rise in interest rates, the economic slowdown having an impact on home builders. And as we sit here today, we own a number of them. Lennar is not one of them. We own Toll, which we like because it skews to sort of higher income cohorts.
Luxury homes, yes.
Correct. We like Polte because it's sort of broad-based and diversified across the country. Our take is very positive on home builders. We had some fits and starts last year simply because the rate cutting narrative was pushed out to this year, but more importantly, gross margins for home builders were still elevated in 2025. As we sit here in 26, gross margins for the home builders have been reset. That's number one. And then number two, over the last several months, we've seen some pretty impressive relative strength from the group.
Okay. So you wouldn't mind putting money on the table for housing on a day like today?
Sure.
Okay. All right. Let's go back to the phone lines. Anita's on the line. She's in Markham. Hi, Anita.
Hi, good afternoon, Marilla and Julien. Thank you for taking my call. I too have a high regard for Gordon's advice. Anyway, my question is on Stryker. Of late, I find the price falling down rapidly. Is there more to the story or than what meets the eye? Could I have your advice on this, please? Thank you.
Okay. Thank you for the question. What is your take on Stryker? It has been moving down.
Yeah, Stryker's been moving down, and I'd say there are a couple of dynamics. The first, as it pertains to the group, Medtech companies have been relatively weak, whether it's Stryker, Boston Scientific, even Abbott. The group has been weak. And that's, I think, due to the fact that post-COVID, when hospitals reopened, you had this massive backlog that created and along with supply chain disruptions, that created some pricing power for these companies along with volume recovery. Well, volumes have now normalized. That's the first thing. And second, the pricing tailwind that we had seen in the last 2 or 3 years has become more of a headwind. In our view, Stryker is a very high quality company. Right now, it's going through some cyclical challenges along with its peers. For an investor that has a long-term time horizon, doesn't hurt to own it. For us, we're not involved, and we don't think the investment is timely.
Okay. That was for Anita. Let's move on to Faisal in Toronto with a question. Hi, Faisal.
Hi, good afternoon to both of you. Julien, it's good to see you back in the guest chair. Impressive inaugural visit when you were on last time.
Thank you.
My question is on Boston Scientific. It hasn't done well. Earnings came out. It got knocked down. Can I have your views on the long term on this stock, please? Thank you.
Okay. Would you put this in the same category as Stryker?
Yeah, so Boston, they specialize in everything to do with the heart. So Stryker hips and knees. Boston, they specialize in electrophysiology. That's been a core driver for them over the last couple of years. They had some very impressive product launches in the area. And I think what happened is two things. The first is Wall Street expectations got way too excited. The franchise was expected in their EP business, was expected to have little to no competition. And what we're starting to see is competition emerge from other large medical device companies. And secondly, their leadership position is in question, not just because of competition, but because of a recent acquisition that they did or announced.
Why is that put a question mark over them?
Well, I think they paid sort of a hefty price for something that was viewed as a complementary offering as opposed to something completely niche or differentiated. That's the first thing. And then the second thing, from our perspective, while the headline valuation on Boston Scientific appears attractive, I think it's 22, 23 times adjusted earnings. When you look at the free cash flow generation of the business, it's not particularly great. So Boston was priced for perfection. We've gotten less than perfection. It's being punished. Is the market done punishing the stock? I actually don't think so. For us, it's a wait and see. And Mirella, what I would say, we were actually looking at purchasing the company maybe a month or two ago. And in light of some of these risks that we saw, we decided to hold off. And we're on the sidelines for now.
Interesting. All right, we're going to take a quick break. We'll get to more of your phone calls and your emails for Julien Nono-Womdim of Goodreid Investment Counsel. He's taking your questions on American equities today. Here's the information to reach us. We're back in just a moment. Welcome back. Let's go to the phone lines. Tony's on the line. He's in Ottawa today. Hi, Tony.
Hi there, Julian. Your take on United Health.
Okay, thank you for the question. Short and sweet. United Health's been beaten down quite a bit and hasn't really made much of a turnaround. Are you guys in the space in the U.S.?
We have a position in Elevance. We were of the view that because of their product mix and how they manage the payments, they'd be spared by the industry challenges, which hasn't been the case. So it's not just a United issue. It is industry broad-based, and it has to do with, in our view, two things. The first is elevated medical costs. The demographics in the U.S., population's aging. Older patients are more expensive patients. That's something to consider. So you have a structural increase in costs. And then the second is reimbursements. And there, the administration and the government has been very focused on reducing the burden of costs in terms of healthcare for the country. So while the track record on United has been really strong over the last several years, these issues are likely going to persist. We don't have a differentiated insight as to when they resolve. We're on the sidelines. We think there are better opportunities elsewhere.
And are you on the sidelines for the sector or just United Health on its own?
We're on the sidelines for managed care effectively. We have a position, but we're not adding to the sector. In fact, we may even exit.
Okay.
Yeah.
All right, let's go back to the phone lines. Deborah in Okanagan Falls has a question. Hi, Deborah.
Oh, hi. Good morning, everybody. Today, my question is on GM. Gordon has been behind GM for quite some time, and when it reached a 52-week high at $87, I just had to sell a partial position to take some profits. So my question to you today is, what are your thoughts on GM? I know Ford is coming out with earnings today, so I'm going to hang up and listen.
Okay. Thank you for the question. What are your thoughts on GM? It is down, and all of them are doing these write-downs for EVs, which I imagine is going to affect some things for some time.
Yeah, well, I think Stellantis had a.
They have the big one.
That's
yes.
right. So GM, we own it. We like it. I think last time I was on the show, we talked about it, and there's been a lot of volatility in the sector, particularly around trade, et cetera. GM, as a U.S. OEM, has a structural advantage. First, it's the sort of biggest population in terms of developed markets, and they are effectively getting a stronghold to the country thanks to the administration. So that's a positive for the company. Second, there's a cyclical recovery. At least we expect a cyclical recovery in auto volumes and auto demand. If we go back to this idea that the U.S. economy can, or at least consumers can recover in the back half of the year, that should be positive. So we like it. We continue to own it. That's how I'd leave it.
Okay. Let's go to an email from Rob then. Rob is in London. He says, what are your thoughts on Hershey, HSY-N? Is it time to harvest some gains or let it run? We'll pull up the line chart for Hershey in just a moment. What are your thoughts on Hershey and this kind of company right now?
Yeah, I think what's going on is the broad consumer sector, staples in particular, are having a good start to the year. They had underperformed in recent years for a couple of reasons. The first being, you may have heard of shrinkflation, where all these consumer packaged good companies effectively started selling you the same chocolate bar, smaller size for more money. So pricing was egregious during that time frame. Volumes began to weaken, and as a consequence, these stocks got punished. And now we're on the other side of that, where volumes have now normalized. The valuation had gotten a little too attractive for the underlying quality of the businesses, and so they're getting a bid. We're not in the habit of selling sort of 52-week highs. The reason why they're doing that is understandable to us, but certainly wouldn't be adding here. Perhaps we might get a pullback or rotation, which may prove to be a good time to add. But no, our recommendation is to stay pat.
We know that Pepsi says it's going to start changing some of the sizes of what it sells, so maybe try and give the consumer a little bit more bang for its buck. Do you think some of these other companies are doing the same, sort of reflecting on the shrinkflation and making changes?
Yeah, I think on the products themselves, they're going to respond to consumer behaviors. One thing that I didn't add, which is also pertinent, when the GLP-1 drugs came out,
yes, of course,
there was a concern that consumers would stop eating chocolate bars. Well, that hasn't actually proven to be the case. And so there's a renewed appreciation for the underlying quality of these businesses by the marketplace. I think that's what we've seen so far.
Okay. Let's get to another email then. This is from Hank in Vancouver. He says, would you buy Caterpillar or John Deere if you had to pick? Which is the better investment? Both of these companies lend out equipment. Caterpillar has done pretty well lately. Are you invested in either of these?
We don't own either. We have a great deal of industrial exposure across other companies, but we do recognize Caterpillar's done really well. Again, going back to this sort of industrial activity pickup, particularly in the U.S., what I'd say is farmers, as it pertains to John Deere, have had a tough time in the last few years. We're starting to see agriculture-related equities starting to do well. We're also starting to see the U.S. administration potentially striking a deal with farmers in China. Canada is actually going to be reinvesting in food exports. So globally, there is a renewed interest in investing in farming and food security. That should bode well for John Deere. We like it. We're looking at it. I'd probably buy Deere at these levels.
But at some point.
Sure.
Got it.
Yeah.
Okay. Let's take a quick break. We are going to go through past picks from Julien. When we come back, stay tuned for that. Welcome back. Time to look at past picks from Julien from September 15th of last year. At the time, he chose Piper Sandler, PIPR, on the New York Stock Exchange at $349.64 US, up to $373.03 right now, 7% upside, 7% upside for total return as well. Investment banking, what do you like or do you still like about Piper Sandler?
Yeah, we still like it. We still own it. In the interim period since we last spoke, the recovery and sort of M&A activity, particularly moving down to smaller companies, has been delayed. It's been delayed for two reasons. The first being there's been a great deal of geopolitical noise in the world. That's number one, which sort of makes it difficult to have that IPO window open. And the second, there's been a lot of repricing in the software complex. That has created a hesitancy in terms of going to market. The reason we still like it is while software is perhaps temporarily impaired, we think that high-quality software assets will eventually come to the market and they will find a home in public investors. And secondly, beyond software, whether it's in regional banks and other areas of the economy, we are seeing M&A and deal activity percolating.
Okay, so this is something you're going to hold on to until you see the change.
Yes, correct.
Okay. Let's get to your next past pick, Freeport-McMoRan, FCX on the New York Stock Exchange at 45.64 US at the time, and now to 62.43, 37% upside. Total return is the same. They do natural resources. Have they picked up on sort of gold, or why has the stock done so well?
It's done well for a couple of reasons. The first is we have a view that there's a structural deficit in copper supply globally. They're a large copper producer. And the demand for copper is not just AI, it's electrification, it's really everything in the economy. Shortly after we spoke, the company actually had an unfortunate incident at their Grasberg mine in Indonesia. So in the interim period, copper supply has actually tightened significantly while demand signals have improved significantly. So copper is up. And then the second thing is that the company has gold byproducts. And so as gold prices go up, these byproducts are high margin revenues for the company, and therefore the stock has done well.
Okay. Let's move to your last past pick then from last year, Harrow, HROW on the NASDAQ, 42.82 US at the time and 47.20 today. So a 10% upside for return and total return. And they're pharmaceutical, but specifically for eye care?
Correct, yes. Eye care, they have some fast-growing drugs. The stock has been very volatile. The launch in their VEVYE product has been good, perhaps a little slower than investors had anticipated a couple of quarters ago. We continue to own the stock, and we think that they have an opportunity to grow significantly in the coming years.
Is there much competition in this space?
There's a lot of competition in ophthalmology, but they've been very intelligent at incubating and acquiring strategic assets and forming relationships with doctors as well.
Okay, and you think that's a secret for their success moving down the road?
We think so, yes.
Okay, let's take another quick break. We'll get back to your phone calls and your emails in just a moment. Stay tuned. Welcome back. Let's go to an email from Marie in London, Ontario. She says, I bought into Bitcoin back in April of last year when TariffGate happened. I'm officially in the negative from that investment now. What does the guest think about the recent drop in Bitcoin, and should I be panicking? Last I looked, Bitcoin was at about 69,000. There we go, 69,626. What are your thoughts first generally on Bitcoin, and then whether or not this dip will pick back up?
Yeah, I think in terms of Bitcoin, first, what is Bitcoin? I think people view it as an alternative store of value, in which case, if that's the case, then one shouldn't really be looking at sort of volatility in the asset, because volatility is going to be ultimately driven by liquidity, right? If people have liquidity, they put more into Bitcoin, and if people are getting margin called because gold and silver are down, maybe they withdraw capital from Bitcoin. So my first question it would be, what was the reason you bought Bitcoin? Was it a speculative purchase, in which case you thought Bitcoin would go up over the next 3 to 6 months? Or is this a store of value because you have a structural view of other forms of money, right? In our case, we view Bitcoin as not providing any cash flows. We don't know how to value the asset. And in an instance like this where it's down, we don't know how to explain
why it went down.
Why it went down, and what is the catalyst for it to go back up, other than, well, other people are going to want to buy it. That is, in our view, not a sound investment thesis. And as it pertains to the short term on Bitcoin, could it go down to 50, 40,000? That's totally possible.
Okay, so she's got to make that decision based on what she believes and how she placed that first investment.
Correct. What is her belief surrounding Bitcoin? Ultimately, it's a belief system. And so if she fundamentally believes that Bitcoin is an alternative store of value, then volatility shouldn't be viewed as a negative, but as a positive, actually.
Okay.
Yeah.
Okay, let's go back to the phone lines. Peter is in Victoria, BC with a question. Hi, Peter.
Hi there. Thanks for taking my call. My question is on Algonquin Power, which sounds like a Canadian company, but as we both know, they report in U.S. dollars and most of their holdings are in the U.S. I'd like your opinion on. It seems to be coming back now. Thank you.
Okay, thank you for the question. Pulling up Algonquin Power, there it is. What are your thoughts?
Thanks for the question, Peter. Yeah, Algonquin has gone through a pretty significant transformation. As you may recall, the company had some pretty significant issues in 2023 or so. They cut their dividends a number of times. I think they'd over-invested in renewables. Since then, you had an activist investor, Starboard Value, that came in, recentered the business around its core utilities franchise. They've had some leadership changes, and we think it's an improving utility. We think it'll do fine relative to other utilities. I mean, the turnaround has been successful in our mind.
Okay, that was for Peter in Victoria. Let's go to Paul. He's in Oshawa, Ontario, with a question. Hi, Paul.
Hi. What I guess thoughts on Medtronic as an investment? I'll hang up and listen to you, please.
Thank you for the question. Can you tell me about Medtronic?
Yeah, Medtronic is a medical device company similar to Boston, similar to J&J. It's a large, diversified Medtech company. Short to medium term, positive on Medtronic. We think that the business continues to work. They've had some recent product launches, and they're really attacking the likes of Boston. They're attacking other peers in the industry, and we think they do well. What I'd say, however, is that unlike some of its more concentrated peers in terms of end market exposure, they simply don't have the R&D wherewithal to maintain strong product leadership. And so Medtronic is more of a trade, not a long-term investment in our mind.
Okay, so their business model works differently. Essentially, are they looking more just to take on other companies rather than develop their own in-house? And if so, how are they taking them on?
No. They build and develop products in-house, but because they're a diversified company, so if you look at Stryker, hips and knees, that's all they do. Boston, they focus very much in terms of electrophysiology. That's their core niche. Medtronic doesn't really have a core niche. They're very diversified, and it's a very large company. In many industries, if you take financials, for instance, larger companies tend to do well. They gain efficiencies. In medical devices, one of the interesting dynamics is that they have price goes down year after year, going back to medical costs. So one way to offset medical costs is prices come down. So because of that, the larger you are, the more you have to absorb this negative pricing on a year-over-year basis, which is obviously very challenging. At the same time, you're competing with companies that have a more focused R&D budget. And so that makes it challenging to maintain or even gain product leadership. And so in recent years, we haven't really seen product leadership from Medtronic. However, as a stock, valuation got a little too cheap, and they've had some decent product launches, which should support the stock for the next maybe 12 to 18 months. Beyond that, we don't view it as a long-term hold because of those structural issues I just described.
Got it. Okay, let's go to another caller then. Paul, sorry, I missed Paul. Let's go to an email from Matt. Matt says, what are your thoughts on Fiserv? They beat on top and bottom line. The company let go of the CEO, spent a lot on share repurchases, and now repurchases are at a 6-year low. So Fiserv.
Yeah, Fiserv, I'll extend the sort of the question to the whole payments ecosystem. And this is where I'll have to admit, we find it very challenging to value these companies. A lot of them are operating in very competitive end markets. A lot of them have grown through acquisition, and so their tech stack is quite noisy. And lastly, they've been punished by the market. They've really been punished by the market. The capital allocation, sure, it's an improvement, but we don't know that it will be sufficient. So we're not involved, and we have no intention to do so in the not too distant future.
Okay, let's take another quick break, then we'll get back to your phone calls in just a moment. Stay tuned. Welcome back. Let's go to an email from Bill. He says, what does Julien think of Costco? What do you think of Costco? They've got an interesting business model, and subscription, I guess, does them very well.
Yes. In terms of the business, we think it's one of the greatest businesses on earth. The subscription model, the customer satisfaction is off the charts. As it pertains to the stock, at 50 times forward earnings.
I was going to ask you, yes.
It's very, very expensive. So here's my answer, and I hope you don't take it as a hedge. If you have a long-term time horizon, I'm talking decades, arguably one of the best longs you could buy in the marketplace. If your time horizon is shorter, 12, 18, 24 months, the valuation doesn't leave a lot of margin of safety.
Okay. Yeah. So if you already own it, you can hold it. If you're going to hold it for decades, you think the valuation will decrease in that time?
No. Once you get beyond a certain time frame, the driver of returns is earnings and revenue growth and ultimately earnings. So the compounding, the intrinsic compounding of the business renders the valuation question not less important.
Okay.
Yes.
All right. Let's go to another email. Do we have another email from Wayne that we can pop up? We'll have a look at that. Wayne says, would you invest in U.S. financials like Morgan Stanley? We talked a little bit about U.S. financials when we were talking about J.P. Morgan.
Yeah.
Would you pick up at this point in financials?
Yeah, Wayne, thank you for the question. We like U.S. financials quite a bit. I think we've talked to a lot of different guests, and a common theme has been the weakness in Mag 7. Mm-hmm. Our U.S. large cap strategy, which Gord runs, did extraordinarily well last year, and many of the drivers of that was our significant allocation to financials because of the themes that we've talked about: loan growth reacceleration, strong capital markets activity, investment activity resurging, and even on the M&A front. And so Morgan Stanley is a prime example of that. We continue to own it, and we continue to like it as well. And we'd certainly add here for sure. Give
me an outlook for financials for 2026. I mean, clearly they're going to benefit from perhaps tax deregulation. You said some of them will benefit from the bill in other ways, or might be more M&A this year. So what is your outlook more broadly for the sector this year?
The outlook for the sector is positive, and I think it's a continuation of 2025. And so if we go back to the M&A story, 2025 was a good year, not a great year. We think 2026 will be an even better year. And broadly speaking, as we like to say, banks are the lifeblood of the economy. And to the extent that the U.S. economy is going to chug along in 2026, which is our base case, banks will participate in that. And another thing is that over the last 12 months, we've had a re-steepening of the yield curve, which means that lending for banks is a little bit easier because they can actually price these things in a profitable way.
Okay. Let's get to one email. Then we have an email here from Susan. She says, what do you think of Apple? We talked about the Mag 7 coming off a little bit and more broadening of the market. These companies are reporting. Apple did very well last quarter in phone sales, phenomenally well.
Right.
But moving forward, is this shine going to continue to come off of the Mag 7? Would you put new money in at this point?
Yeah, we think Mag 7 likely continues to be a bit weaker, given our view that there's a broadening of market participation. In terms of Apple, as you know, we've owned it for a very long time. Stocks don't go up in a straight line. It's one of those companies where, especially when they're performing well, pay attention to what the business is doing and let the stock breathe a little bit. That's our take.
Okay, so would you put new money in today, though?
No.
No, interesting. Okay, let's get to one more email from Patty. What does Julien think about Micron?
Micron. So Right now, one of the key bottlenecks in the AI investment cycle is memory. More data requires more memory. Micron has done phenomenally well in terms of their ability to provide to the hyperscalers, et cetera. Supply for memory is tight going out several quarters and perhaps even more. We don't own Micron. We think we have better investment opportunities elsewhere, but we expect the shares to continue to do well, simply because the cycle is super tight in terms of capacity. Because
memory has been a more recent story, but still, as you can see from the chart, has already run. Would you pick it up where it is? I mean, it's a little off now, but would you pick it up at the level where it is today?
Yes.
Really?
I would. The reason is very simple. The memory industry went through its worst down cycle in 2022 or thereabouts. And consequently, their willingness or propensity to add capacity in this cycle is going to be a lot lower than would have been in previous cycles. In other words, they're scarred from the downturn. I mean, SK Hynix was in sort of dire trouble. Micron was in trouble, and so is Samsung. So we think that they will intentionally keep the cycle tight. However, at a certain point, the stock market will reprice the addition of capacity, and so one needs the ability and the willingness to stomach volatility.
Okay, but you expect it to be volatile moving forward?
Correct.
Okay. Let's do one more email I think we have from Eric. What do you think about holding the S&P 500 equal weight over the regular market cap weighted index? Which way would you go?
Yeah, I'd pick the RSP, the equal weight over the market cap weighted.
Why is that?
Well, again, earnings participation from the other 490 odd companies, while the Mag 7 will continue to do well, their valuation kind of reflects that. Other companies, whether it's, we were talking earlier about Deere, we're talking about other companies, or even Hershey, we'll talk about all these different companies in the market that have gone through various phases of cyclical slowdown, and now it appears as though they can reaccelerate, and more importantly, they have a little more valuation support.
Okay. Let's take a quick break, then we will have new top picks from Julien when we come back. Stay tuned for that. Join us tomorrow for Market Call. Chris Blumis will be on the show. He is portfolio manager at Raymond James Investment Counsel. He'll take your questions tomorrow on North American large caps. And if you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Julien. We're going to start with Citigroup, C on the New York Stock Exchange. For financial for the U.S., this is one you like more than others right now. Why is that?
Well, a couple of reasons. The first is, as you say, we like the sector, so we're in the right neighborhood. And then the second, it's still an ongoing turnaround. So the CEO, Jane Fraser, has done a fantastic job at improving the operational efficiencies in the franchise. And we think that those operational efficiencies are going to improve. As a result of that, we think that the valuation, which is still a discount relative to peers, will close the gap as their return on tangible common equity improves. And so that's one that we like, and we think the immediate catalyst is going to be their May 2026 Investor Day. As we get into that, we think the stock should do well.
I'm wondering about AI as well, because we're beginning to hear and see financial services company benefit from AI taking over the back room and some of the jobs that were done by people that were repetitive, for example.
Sure.
Is that going to be a lift for the industry overall this year, do you think, and Citigroup in particular?
Well, I think when people say a lift for the industry, we don't view it as a differentiated lift, because every company or every large company of scale is going to make these initiatives. As a consequence, that reduction in cost, some of that is going to be passed along to the customer. And if the ones that are better at improving their efficiencies obviously will have a slight pricing advantage. But obviously, from our perspective, is merely an industry tailwind that doesn't really add any differentiation. It's as think of when companies started having PC computers, right? Like you don't go to one bank versus the other because one has a computer and the other one doesn't. But
you think they're all going to advance from the use of AI in the back office?
Correct.
Okay. All right. Let's get to your next pick then, which is Merck, MRK on the New York Stock Exchange. Pharmaceuticals have been coming back.
Yes.
They were very off last year.
Yes.
All of them are fighting about the same kind of space right now, which is sort of the obesity drugs, that kind of thing. Why do you like Merck over the others?
Well, Merck specifically, it's a debated stock. So debated sector, debated stock. In terms of the sector debates, we think policy certainty is improving or has improved, and we expect that to continue. Second, in terms of the debated stock, Keytruda, which is their oncology drug, represents a significant portion of revenues, close to 50%. And investors have shied away from the stock because there's a patent cliff in 2028. However, the company has invested significant R&D dollars into finding the next drug. They've also done some strategic M&A. We even think that they have capacity for more M&A. So our view is that the valuation does not reflect its underlying R&D pipeline and recent drugs that have made it on market.
When they lose the patent,
Yes.
How much of a hit could that be?
It's not immediate. It typically sort of peters off over time, and I think that's another point in their favor, is that the market sort of prices in that it's going to be a sort of material hit right away. We think the hit will be gradual, but even with the hit, the offsetting growth drivers should benefit the company.
So there's not a big cliff they're going to walk off.
We don't view it that way.
Okay. All right, let's get to your next pick, Celestica, CLS on the New York Stock Exchange, very well-known name. This is part of the AI build-out. You think that they will benefit this company?
Yes.
Tell me more about that.
Yeah, so we've owned Celestica for a while now, done quite well on it. And as we look at the company today, we think that the tailwinds continue. First, revenues are positively correlated with data center CapEx. And as we've seen in the last week, CapEx numbers are increasing quite substantially across the hyperscalers. So that should be positive for Celestica. The second point is we're going through a network switch technology upgrade from 800 gigs to 1.6 terabyte. We think that will benefit not just revenues, but also margins. And if I were to add something else, we think that the transition from training, i.e. AI training, to inference, which is usage by you or I, will also benefit the company. So while the valuation is sort of elevated from PE multiple standpoint at, call it 30 times, we think the acceleration in revenues is going to be overwhelmingly positive.
People have been talking about the perhaps overspend in CapEx for some of these hyperscalers.
Yes.
If that ends up being fact or true, they're building too much, or they turn around next year and say, we have to cut back on our spending, we overestimated.
Yes.
Could that affect a company like Celestica?
It certainly will. Not it could. It certainly will.
Okay.
Yes.
And is that a concern for you?
At this moment, no, but it's something that we're actively monitoring. If there's one thing we're paying attention to is that particular inflection. If and when AI spending resolves to the downside, many stocks, certainly Celestica and many others, are going to be punished quite severely.
So what would that take? An announcement from one of the hyperscalers saying we're pulling back on CapEx spending?
No, not an announcement. By the time the announcement arrives, it'll be too late. We spend a great deal of time looking at alternative data sources and staying abreast with what's actually going on in the industry. We have other industrial companies in our portfolio that are responsible for building some of these physical infrastructures. So when their backlogs start slowing down, that will be a tell. There are a whole host of data points that we have to pay attention to as active investors.
Got it. All right. We're going to leave it there. Julien, thanks for coming in.
Thank you for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.